Good afternoon, everybody, and thank you for assisting this webinar presented by SSQ Insurance. My name is Matthew Roy, Fund Development Analyst. We are pleased to welcome today Matthew Tanguay, President and Senior Partner, and Scott Collins, Founding Partner and Portfolio Manager at Triasima. They are here to talk to us about their unique managing methodology called Three-Pillars Approach and their Diversified Canadian Equity Strategy, the underlying strategy for our SSQ Triasima Canadian Equity. Please note that if there is enough time at the end, we will be able to answer one or two questions that you can ask via the Q&A sections of the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Matthew, the floor is yours.
All right, thank you, Matthew. Thank you everyone for being here today. So you have the presentation in front of you. What we'd like to do today is to first introduce you to Triasima, tell you a little bit about our story. Then my colleague, Scott Collins, who's one of the founders, will also run you through the investment methodology, and then we'll focus on the SSQ Canadian Diversified Equity Strategy. So we'll talk about the strategy, its performance, positioning, and so on. And as Matthew said, we'll be happy to take questions at the end of the presentation. So on page 3, you have a few key information on Triasima. Matthew, if you would bring it to page 3, please. Yeah, so on page 3, so you can see that Triasima has been around since 1998, so we're celebrating our 20-year anniversary this year. So we're a well-established firm, still independent and employee-owned, but we now have 30 employees, all of whom are located here in Montreal. We're known across Canada for our unique approach, which is called the Three-Pillar Approach, and Scott will run you through this approach later, but simply keep in mind for the time being that we apply this methodology to any of the strategy we manage. We adapt it to each strategy, but it's always the same philosophy. Also, we're currently managing or having an asset under management of $3.7 billion. So it's a interesting size because we're still considered a boutique. We're still very nimble and very flexible. But on the other hand, we've reached significant milestones over the last few years, which allowed us to invest in our people and in our technology, which makes us scalable now. At the bottom right, you can see the different asset classes we manage. We've been managing Canadian and foreign equities since 1998, but in the institutional world, we're known primarily for Canadian equity, which is what this strategy is about. So 82% of our AUM is Canadian equity. On the next slide, you can see our team. So here you can see it's a team of 30, as we said before. And on slide 5, we can zoom on the portfolio management team. So on the following slide, you can see the 9 individuals that are part of the portfolio management team. Matthew, if you could go to page 5, please. So Triasima back in 1998 was founded by 3 individuals. So Scott Collins, who's with me today on the phone, but also André Chabot on the top left, and Redouane Kirigin. So all 3 of whom are still with the firm today. But obviously, fast forward 20 years later, it's the same unique methodology, but with much more resources. So we've added analysts through the years, we've added technology, so the track record you'll see is already quite good, but we're quite optimistic about our future. So that's Triasima in a nutshell. Now, we can talk about our investment approach. On page 6, you have our philosophy. Page 6, please, the previous one. So in terms of philosophy, so what we try to do, what André, Scott, and Redouane, when they developed the Three-Pillar methodology, what they tried to do is really bring science and discipline to the art of portfolio management. So in other words, they wanted to bring more robustness to the typical investment process. And to do that, they felt they needed to be systematic and use very well-defined inputs, which in fact are 3 different and independent investment methodologies: fundamental analysis, quantitative analysis, and trend analysis. So we use all 3 of them in a holistic way, and Scott will run you through these methodologies a little bit later. The ultimate goal for any of the strategy we manage is to beat the benchmark with less volatility, so lower risk and a capital preservation feature. And to do that, what we try to do is really to build portfolios that will outperform in most economic environments. And we try to have portfolios that have better parameters than the indices. So for example, what we try to do in this strategy is really to have a portfolio that is as cheap or cheaper than the benchmark, but that has much more growth. And as a result, we think that with such tailwind over the longer term, we'll increase our probabilities of outperforming the benchmark. And finally, what's very important to us is to have a strong self-discipline. In other words, a lot of managers, a lot of our competitors can talk at great length about why they add a stock to the portfolio, but when you start talking about selling discipline, the conversation can be very short. In our case, as Scott will show you, our methodology is as useful for selling as it is for buying, and always within a disciplined and robust approach. So without waiting anymore, I'll let Scott tell you a bit more about our methodology.
So good afternoon to everyone out there. Just very quickly, we're going to talk about the portfolio management process. We will talk about the mandate. I've got a couple of comments on the macro, a little bit on the outlook, and I think we're going to wrap it up with performance and open up for questions. So we're going to just move to page 7 and talk about the portfolio management process. So the portfolio management process is made up of 2 distinct but equally important parts. The first part is the investment methodology, so that's depicted by the top part of this slide. This is the tool that we're using to assess how attractive a name is, and this is where we use our 3-pillar approach that we're going to get into in just a minute. So for this step, it's the full portfolio management team, or 9 individuals that contribute to the scoring of the individual securities. Second part to the portfolio management process is depicted by the bottom part of this slide. And this is portfolio construction. This is where we have rules and criteria with regard to how we build a portfolio and how we maintain that portfolio over time. For this step, it's always 2 portfolio managers that are responsible for implementing the decisions and maintaining the portfolio. So let's talk about the first part to the portfolio management process, which is the investment methodology. So that's the top part of this slide. The investment methodology is the tool that we're using to assess how attractive a name is, and it's how we're buying and selling securities in the mandate. But the way that we manage money is really quite unique. We can't seem to see any other group really right around the world that manages money quite the way that we do. So there are 3 analytical methods that one can use to analyze markets, securities, and manage money. And that's fundamental, quantitative, and trend. And at Triasima, we formally incorporate all 3 in an integrated manner. The top part of this slide is a visual description of the investment methodology. And as you can see, those 3 analytical methods, they're segregated into their own silos, which we call a pillar. So any stock idea that we have or any name that makes it into the portfolio needs to run through each one of those pillars. Each pillar is independent with its own set of criteria, and each pillar is going to derive its own score. So if you look within each of those pillars, those colored triangles or funnels, you can see that the best score a pillar can be is +2, and the worst score is -2. That means if you add those 3 pillars together, the best total score a security can be is +6, and the worst total score a security can be is -6. So if I just direct you to the scoring grid below the 3 pillars, you can see that the lowest score is a -6 in the red, running right up to a +6 in the green. We have a strong preference of buying securities with a total score of +2 or better, so in that green zone. And then as those scores deteriorate and move into the negative areas, those securities become candidates to become sold. So that is a very high-level review of the investment methodology. It's obviously more comprehensive than this. I thought maybe what I'd do is explain each pillar in a little bit more detail, and then we're going to wrap it up and move on and have a look at the portfolio itself. So if we could just move to page 8. We've exploded the investment methodology. We have a few more details around each one of the pillars. I think the first thing to understand is that the pillars on the left-hand side, so the trend and the quant pillars in the blue and the green, they add a lot of value to the investment process, and that's because these pillars have very little emotions associated with them. So they keep us really disciplined about what can go into the mandate and when something has to be sold. But I'm going to leave those for the time being. I'm going to start with just talking to you about the fundamental pillars, so that's the top right-hand side in the purple. So the fundamental pillar is fundamental analysis. It's the classical analysis most portfolio managers employ. It's really understanding a company's situation and building out a scenario. And we do fundamental analysis just like everybody else. We meet with hundreds of companies every year. Really, this is where we spend the majority of our time, and that's because the other two pillars are highly automated. I think one of the important things for you to understand about our fundamental analysis is we're actually quite top-down oriented. It doesn't mean we don't do the bottom-up. We actually do, but we do a fair amount of top-down work. So that means we have a look at the macroeconomic environment around the world to see how that filters into Canada, into the sectors, industries, and finally the Canadian companies themselves. So that's a little bit about the fundamental pillar. It's, again, it's the classical analysis portfolio managers employ, and it's the qualitative part of the process that the other two pillars cannot incorporate, and that's because the other two pillars are automated. Just so you understand the scoring a little bit, the fundamental pillar, there's 5 possible scores. As I mentioned before, your best score is a +2, your next score is a +1, a 0, a -1, and a -2. So depending on the strength of the situation, we're going to allocate a score to that security for that pillar. Okay, so let's move on to the non-emotional pillars next. I'm going to start with the quantitative pillar, so that's in the green at the bottom part of this slide. So here we're using computers to screen and rank securities on a combination of variables that we've determined to be value enhancing. So this is a multi-factor model. We're screening a universe of securities. The names near the top of that screen will tend to outperform over time. So we're screening for such items as profitability, such as return on equity, earnings growth, margin expansion, things of that nature. So the quantitative pillar, it's highly automated. It's computerized. We simply push the button, the system's going to produce the results. There's very little emotions associated with it. In terms of the scoring for the quant pillar, it's relative scoring, so there's always a name which is the best and a name which is the worst. If you have a look at the text box, just the right-hand side of that green triangle, you get a sense of how the scoring works. You can see the top 5% of the screen universe will receive a score of +2. It moves to a +1, running right down to a -2. Okay, so that's a little bit about the quant pillar. So that brings us to the second non-emotional pillar, which is the trend pillar. So that's on the top left-hand side in the blue. So our trend analysis uses tools from the world of technical analysis. We're not actually performing technical analysis. We're performing trend analysis. We're simply trying to gauge the basic trend of the security, and the reason we do this is because there's a lot of sentiment and momentum in a trend. And trends typically last longer than people think. So a stock which is trending up tends to have a higher probability of moving up, and vice versa when it's moving down. If you can imagine a security which is trending up, without knowing anything about that security, you know that something good is happening there. That stock is being rewarded for something to do with its underlying business, and value is being added to the share price. That's something that we very much like to see in any name that we own, obviously, or any name that we're about to buy. A situation like that is likely to continue for some period of time. A security which is in a deep downtrend, again, without knowing anything about that security, you know something bad is going on there. That stock is being penalized for something to do with its underlying business, and value is being stripped away from the share price. A stock which is in a deep downtrend is a big red flag for us, and it's more of a sell signal to us than it is of a buy opportunity. Okay, so that's a little bit about the trend pillar. It's obviously far more comprehensive than what I've explained. We're using 9 trend indicators over 3 time horizons. Just like the other 2 pillars, there's 5 possible scores. Your best score is a +2, running right down to a -2. So, for example, stocks in a strong uptrend, it's a +2. If it's oscillating back and forth, the score is likely a 0, and if it's in a deep downtrend, then the score would be a -2. Okay, so that's a little bit about the trend pillar. So at this point, you can see each pillar is independent. with its own set of criteria, and each pillar is going to derive its own score. What we do is we simply add the 3 scores together. If the score is above a certain level or if it's improving, then the name is considered for purchase. If the score is below a certain level or if it's deteriorating, then the name is considered for sale. So that's a little bit about the investment methodology. It's the tool that we're using to assess how attractive a name is. But it's only the first parts of the portfolio management process. The second part is on slide 9. So this is portfolio construction. This is where we have rules and criteria with regards to how we build a portfolio and how we maintain that portfolio over time in order to control and mitigate risk. The idea here is to build a portfolio which is going to outperform the markets, but with a lower level of risk on a number of different metrics. So what we've done here is we've grouped our key mitigating actions to 4 core areas: diversification, ongoing monitoring, self-discipline, and then alignment with our top-down view. Now, we've got a lot of different rules here. Just due to time considerations, I'm not going to go through them all. I'm just going to give you a couple just to give you flavor for how they work. So, for example, if we look in diversification in terms of sectors, we have minimum and maximum sector weights, which are based on the importance of the sector in the benchmark index. The idea here is that smaller sectors we can be overweight plus or minus 10%. As you move into the larger sectors, it moves up to plus or minus 15%. Another example of a rule that we have is just the point down, a little bit further down, time diversification. This is how we move in and out of positions. We always do it quite gradually, so we typically are going to start with a smaller weight for the initial purchase. We allow some time to go by. We reassess the name. If the name continues to be well-known, we can move forward with a second transaction, sometimes even a third. And we do the reverse when we're moving out of a name. So what we're doing is we're spreading the risk through time as time diversification. Okay, so that's all I'm going to say about portfolio construction. There's a lot more rules, and if anybody has any more questions, we can hit it when we get to the question period. So let's move on to the mandate itself. So that's page 10. So today we're talking about the Canadian Diversified Equity Strategy. This is a flexible Canadian equity mandate. You can invest in the full market cap spectrum from large caps right down to small caps. However, the maximum amount of small caps that can be held in this mandate is 15% of the portfolio. Additionally, we can hold up to 10% of the portfolio in securities outside of Canada. So this is to add a little bit of diversification from an asset class perspective, but also, and more importantly, is to gain exposure to industries that we typically don't have in Canada. So if we think about the Canadian market, it's really dominated by 3 sectors, which include energy, materials, and then financials. The tech, for example, tech sector and healthcare are not very deep sectors, just a few key names there. When you go outside of Canada, in the U.S. or internationally, there's lots of new economy names, you have the Amazons of the world, eBays. In healthcare, there's a lot of biotech in the U.S., pharmaceutical. In the U.S., for example, there's a home builders market. We don't have these types of companies in Canada. So it gives us exposure to these types of companies, which can have very interesting risk-return profiles. Okay, so that's a little bit about the mandate. I'm going to just maybe flip over page 11 to page 12. I'm going to bring it all together by looking at the portfolio as it stands at the end of the year. So obviously this is the output of our 3-pillar process in conjunction with the portfolio construction rules. So this is what we call our 3-pillar scoring page. So here we've listed the 3-pillar scores for every security owned in the portfolio. So you have the portfolio, which is broken out into 2 columns, and the names are grouped by sectors as you would commonly see them, so energy, materials, running right down to real estate. So what we have is the name of the security, the ticker just to the right of that, then you have the equity weight of the name in the portfolio, and then the 3-pillar score is broken out. So you have the quant score, the fundamental score, and the trend score, and then the total score just to the right-hand side of that. What we've done is we've overlaid a heat chart on top of that. The heat chart indicates whether that score has improved or deteriorated from the previous quarter. Green indicates the score has improved. red indicates the score has deteriorated. Darker the color, the more the score has changed. What you'll notice as you look through this page is that names with higher three-pillar scores tend to have larger weights, and those are the names that we have typically bought or we're adding to. Names with poor three-pillar scores are names that we are selling and are reducing, and they also tend to have smaller weights. So if I can maybe just direct your attention to a couple of names here to give you some examples. If we start with energy, there's a name called Crew Energy, so it's the third from the top. We can see the weight is quite small at 0.3%, and that's because we've been selling it down, but it wasn't completely sold at the end of the year. And we can see that the quant score is a -2, the fundamental score is a -1, your trend score is a -2, your overall score is -5. It's really poor. So that name is a candidate that is sold, and it actually has been sold since year-end. Give you an example of a name that ranks better. If you run down maybe to West Fraser Timber, so that's the last name in materials. So that's a lumber producer. It's got a larger weight at 2.1%, and we can see the overall three-pillar score is quite strong at a 4.5. So that name is a solid hold, and it's an example of a name we might be adding to. Okay, so that's a little bit on the three-pillar scoring page. If anybody wants to talk about any of those names, I'm happy to do that in the question period. I think I'm just going to take a few minutes to run through the macro, and then we're going to wrap it up with performance. So you might want to look at page 13 just to show how the portfolio is positioned. The point here is we're kind of running along in a Goldilocks scenario. We're seeing more or less a synchronized move in a global economy, solid numbers around the number in terms of GDP. PMIs are generally high, so that's a good indicator of future economic activity. Inflation is subdued, although it's been picking up a little bit in various areas of the world, mostly wage inflation. Rates are low, and monetary conditions are accommodative. You know, we can look right around the world. We're seeing a lot of strength. If I look at the U.S., the numbers are good. They're solid. GDP, fourth quarter GDP came in at 2.5%. Employment is very strong, and there is a number of actions which are quite stimulating to the economy. So one of the big items is the tax plan that was pushed forward in December. So that's dropping taxes for corporations and individuals. So that's going to it's going to result in earnings growth for corporations, although 2018 is a bit muddled, but 2019 we should see more earnings growth because of that. It also puts more dollars in the pockets of consumers that will go out and spend it. Also very important, although it sort of hasn't been in the news a whole lot, is the bipartisan budget that was passed in February. So that's going to pump another $300 billion into the U.S. economy over the next 2 years. So that's going to be quite stimulative as well. In terms of Canada, fourth quarter GDP was a little bit disappointing. It came in at 1.7% instead of 2%, although it's still, I'd say the Canadian market still, Canadian economy is still fairly solid, unemployment quite low. Our big concerns here really are on NAFTA. What's going to happen there? Will it be canceled, or how is it going to be modified? We don't really think there's any chance. We don't think it's going to be canceled, but there will be some changes going forward. If it were to be canceled, it would be highly disruptive to the market. It would be a fun day. The markets the day that would be announced. The other big issue we have here in Canada is the energy crude glut and egress issue. So that egress is the ability to move hydrocarbons to various other locations and really just to get it outside of Canada, either to the States or to other countries. And I can talk about that. We have egress issues both for natural gas and heavy oil. Clearly, front and center these days are the various trade tariffs and possible trade wars initiated by the U.S. administration. You know, we kind of hear a lot of talk, and then market gets excited, and then the U.S. administration pulls back. You know, our sense here a little bit is the bark is worse than the bite, and we'll see how it all plays out. We're not terribly concerned by it for the time being. So, having said that, economies are strong. The portfolio is a little bit cyclically tilted. So if we look at the way the portfolio is positioned, so if we look at the second to last column, so December 2017, we can see we have very little cash at the year end, although the cash has increased recently. Energy names were quite underweight, but that's a little bit it's not really maybe depicting the correct picture, and that's because the names that we are holding tend to be higher beta than the names in the market. We have a lot of E&Ps, so beta adjusted, we're closer to the market. But you can see in materials, we have a solid overweight. So that's because we're overweight the forest products, as well as we're there for the base metals. We're underweight gold. We're overweight the light cyclical industrial space, and we're overweight technology, which is a cyclical space. So I think with that, I'm going to pass it back to Matthew. Matthew, you can talk about performance, and we can open up for questions.
All right, thank you, Scott. So page 15, 16, you have a few buy and sell examples. We're not going to run you through that, but if you have questions, we'll be happy to. On page 17 is where you see performance. So on page 17, what you see is like at the beginning of the strategy, October 3rd, 2006, had you invested $10 in the SSQ Canadian Diversified Equity Strategy in light blue, you would see how that would have evolved over time compared to the TSX in dark blue. So you can see that it's definitely outperforming and definitely going in the right direction. But on the next page, you can see the details behind that picture. So on the next slide, on slide 18, I bring your attention to the top right number since inception. So again, since October 2006, so close to 12 years of performance, you can see that the SSU Triasima strategy has yielded 8.7%, while the benchmark was at 5.6. So strong outperformance, 3% outperformance. As a reminder, our target is to outperform by at least 2% with lower volatility. So on the return side, it's been mission accomplished. In terms of the details, if you look at the annual return, you can see that over the last 10 years or so, it's been outperformance for 8 of those years, only 2 years of underperformance. And I think in order to help you understand what to expect from this strategy and what to expect from Triasima, we can talk a little bit about 2009 and 2016, which were the only 2 years where we underperformed. During those 2 years, there are like 2 common themes. The first one is that these 2 years were very strong years. But the second theme is that in both cases, the rally was led by somewhat of a junk rally, so a low-quality stock. Like in 2016, think about oil companies, for example, that were near bankruptcy when the barrel of oil was at $27 and multiplied by 2 or 3 when it went from 27 to 40 bucks. So we don't invest in such companies. So when there's a strong and quick rally led by low-quality companies, we tend to underperform. But the good news is, despite the underperformance, in those 2 years, we still managed to yield a fairly decent absolute return. So you can see, especially in 2009 with 27% and 2016 with 9%. In any other situation, we outperform. We typically add more value in down markets than up markets. Especially if you look at 2015, for example, while the benchmark was at -8, we were at +2. And this has been the case for all of our strategies. And even those that were launched before 2007, it was the case as well. So really, capital preservation, outperformance, lower risk than the benchmark is what we're trying to achieve. And that, with this in mind, I bring attention to these statistics at the bottom right. You can see that standard deviation, so overall volatility has been lower for this strategy than the TSX, 12 versus 13%. You can see that our beta at 65% is lower than 1, so we have less sensitivity to the market. And then you can see that our upside capture, in other words, when markets are up, we capture pretty much 90% of the rise, but we only capture 65% of the drop. So we tend, again, to add more value in down markets versus up markets. So that's pretty much us. So as a conclusion, I'd bring you to page 20. So when you think about Triasima, we'd like you to remember that first we're an independent investment firm, so we're not owned by either a bank or a U.S. parent or something, so we're still very flexible and quite nimble. We're known for a unique methodology, the three-pillar approach, which we apply to any strategy we manage. We always try to build portfolios that have a superior combination of growth and value. Again, if you recall, we're trying to be as cheap or cheaper than the benchmark, but have much more growth. And finally, we have a strong focus on capital preservation, which is often key for individual clients. So we thank you for listening to this presentation, and we'll be happy to take questions from here.
All right, thank you, Matthew. So we'll now proceed to the Q&A part of the presentation. So first question, what is your opinion on the price difference between the Western Canadian Select and the Brent, as well as your short to midterm predictions on the matter?
Sure. Yeah. I guess I'll start by saying we don't do a lot of predictions here. It's very difficult to do that, but we do have basic scenarios. Clearly, there is, this goes back to the point on egress I was making when we were talking about the macro, is that we do not have a lot of pipeline capacity to move the heavy oil out of Canada. And what we've been seeing in the recent past is a lot of new heavy oil coming online, all from the oil sands. So you've had Fort Hills come online, you have Curl, and so that's just making the problem a little bit worse. And then we've had one of the major Canada-U.S. lines go down because of an oil spill that's Keystone, and so that created the differentials to spike to sort of $30 or so. Keystone is back online. It's not running at 100% capacity, so that's going to help a little bit. But there's no question you would think that the differentials are going to narrow a little bit going forward. A couple of reasons for that. One, crude by rail, that's going to be picking up shortly, so that's transporting the oil using rail cars. We have a little bit of a problem because we have a lot of grain in Canada, so that's sort of clogging up the system a little bit. There's no question crude by rail is going to pick up. We also have a couple of pipelines which are being built, so that's the Kinder Morgan line as well as Line 3, and so that's going to help alleviate the situation as well. I'm not sure we're going to see differentials getting down quite as low as we've seen 10 years ago, but you would think probably in the next 2 years differentials are going to close up maybe $10 or so.
Great. So the next question would be, the potential for commercial war is all over the news lately. What is your opinion on the subject? Is it a source of concern for you?
I think it's creating volatility in the market. It creates uncertainty. When you look at what's been announced, they're not large amounts. It's not too disruptive to trade. And when we look at trade really just continues to increase between countries. So we think there's a lot of noise in the market, but for the time being, it's not really going to affect the economies too much. I mean, obviously, the big problem is if the rhetoric, ramps up, and then you get more tariffs being put on by different countries. But really, the response to the U.S. administration and China issue from other countries has been quite muted. So we're not totally concerned about it for the time being.
Okay, well, thank you very much, Scott and Matthew, for your time. Really interesting presentation. To all of you who have listened to the webinar, thank you for your participation. And come back in April as Hexavest will discuss their Canadian equities fund performance and positioning. So thank you very much. Have a good day.